Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good afternoon, all. Ira Epstein of Linn Associates with your agriculture update, and this is your weekend edition for Friday, September 28th, 2018. So as we're looking at the markets right now, the grains are all closed. We're about 2:30 in Chicago Central Daylight Time, and they were down pretty good. Yesterday, you had a pig crop report. The market was up about 250 points on it today, even though most of us thought the report looked pretty neutral. Today, we saw the stocks reports come out in the grains, and basically, the corn didn't like it and beans didn't like it. That's the two ways I think you got to look at it. And the adage that big crops get bigger going into harvest is probably something that's at work. These ending stocks numbers, when you get them in the end of September, they're often not that much deviated from as we go later into the finishing up of harvest and so on. It's hard to believe we're talking about that. It's only September 28th. But let's go to the charts because that's what this video is all about. You've seen that we've gone on the monthly chart from 1071 to 810.5, had a bounce, and we came down this week, got back to 811.5. So we have, so far, the market trying to, if you will, establish some support at the 810.5, 811.5 area. For the week, for the month, you were up 12.5 cents. I'm so used to the weekly charts. For the weekly bar chart, you were down 1 3/4 cents. You did make the highest high since we broke down recently to this 811.5, 810.5 zone. I'm not talking about that rally. I'm talking about this one and how the market has come back. When we look at swing lines, and what swing lines do is they're going to look at the previous bar. In this case, each bar represents a week. And I've set up a set of rules to take into account as the market got a higher high week, a lower low week, an inside week, an outside week up, or an outside week down. And according to those rules, the swing line will draw itself. I don't want you to draw it. I want the indicator to draw it. And the pattern is one right now of a lower low and a higher high. That is not the definition of a trend. An uptrend has higher highs, higher lows, lower highs, lower lows, and a downtrend. As you can see, the market is staying under the red line, which is the 18-week moving average of closes. When the market is under that number, I define the bias as being down. When it's over it, the bias is up. When you're sharply under the number like you are here, it is not unusual that if the market rallies, maybe resistance is seen at that number. But as you can see, since basically June, right through here, this line, as you can see that up there, this market has been staying under that 18-week average. Obviously, a lot of this has to do with the trade wars that we've been in with China. As you take a look also at the Bollinger Bands, you haven't been near the lower Bollinger Band since July. You've basically just been moving sideways in the market. When you look at momentum, momentum is pointing up. So we have divergence. We have the bias down. We have momentum pointing up. We have a market without a trend right here. When I look at the soy meal, it's different. What we have is a pattern of lower highs and lower lows, bearish. Bias is down because the market's under the 18-week moving average of closes, and that 18-week average just got under the 100-week, so we have another bearish crossover. In addition, the momentum of the market is staying locked in sideways, which has been bearish through this play. Soybean oil, different. The oil market has got a pattern of a lower low, higher high. This week it came up for the first time since all the way back here at the end of May, actually, and it has hit the 18-week average. It is a sign that this market isn't as weak as the meal market at this point from a technical perspective. In the corn market, what we've done is we came from these break lows in the 340 area up to the green line, which is the 100-week average of closes, and the 18-week, and the market's run into resistance there as expected. You have a pattern of higher lows, higher highs from here. We don't know if this high is going to get up through the 374 or break down under these lows. But as of right now, with the close of the market at 356 and a quarter and the 18-week average at 357 and a quarter, the bias is down. So again, some divergence. We have the momentum pointing up via the slow stochastic reading, the SSTO, the bias down, and the swing lines up. In the wheat market, I see this market as having a pattern of higher lows, higher highs, and while you were able last week to finally get back up and over the 18-week average, putting the market into the bias up, it gave that up this week, and the market has the bias down. So grains are fighting here. They're not making new lows on these moves, but they're still getting nothing but the bearish news in terms of the size of the crops. In the cocoa market, the trend remains bearish. You've got lower highs, lower lows. Now, in the slow stochastic on weekly charts, I don't consider the markets overbought or oversold. I just look for momentum. That is pointing down. If the market wants to extend this break, the lower Bollinger Band might be where it goes, and that number is 1986. The first resistance point on the way back up would be the 100-week average at 2169, and then the 2309 level at the 18-week. In the sugar market, we had a nice rally from 1991 all the way up, from 991 all the way up to 1180 and right back down. In fact, this week it went back through 983. So it's taken no time at all for the market to just make another low. Momentum is flattened out on it. You don't have a trend. You have a higher high and a lower low with downside bias. In the coffee market, today's rally, and I'm using the word today, set off for the week, new highs for the week. You got up, in fact, to 103.45, breaking this pattern of lower highs, lower lows. You'll see on the daily charts, if you go to them, that the market for the very first time has closed over that 18-week average of closes, first time in a very long time. Momentum is turned up as well. So you're out of the downtrend. On the weekly chart, you have not begun an uptrend. Resistance back in the 107.30 area, but given where this market's been in the 92 area, that's a heck of a rally if it gets up there. It's about 8% or so. The cotton market continues under aggressive selling pressure. These are the lowest lows it's recently seen at 76.33. Momentum continues to point down. And as you can see, this market fought a battle. Now let's take a look. If you look at the high right here, it was 83.98. This high became 83.93. So I made a mistake here. I should have this arrow pointing down. I knew it when I was setting up the chart. I forgot to do it. You'd have lower highs, lower lows. Now you're into the support right through here. And yes, I do these charts by myself because who am I going to give it to? I'm the one that's creating it and explaining it. In the cattle market, the market has still got upside bias in terms of, well, let's first talk the swing line. It's got higher lows, higher highs, bullish. The bias is up because you're over the 18-week moving average of closes, and momentum is up. If the market doesn't get held back by the upper Bollinger Band, which are these black, that's the black band, the top one, and the lower one here, they don't run parallel. What do those bands do? They offer you support and resistance points in the market 95% of the time. Via this algorithm, the market will trade within those bands. 5% of the time outside of it. You'll notice you've gotten up to it and it's acting as your resistance. If the market can push forward, 115.80, the 100-week average is the next resistance. And in the hog market, with all the African swine flu that we're hearing about in Asia, you've got the lower low, higher high. You stepped out of the downtrend. Actually, you stepped out of the downtrend, not this week, but last week, ending the 21st, when the market got to 61.72. And now the question is, can it get up to the resistance, up to the 66.77 level? We'll see. Trend, none. Momentum turning up, bias down. A market that's fighting itself. You see me talk about all this. I don't want you to turn off at what you've got. In my charting course, I teach it, and if you write this down, SAVE, S-A-V-E 40. The course normally runs $129.95. It includes all this information with it. SAVE 40 is going to save you $40 on the course, roughly a third of the price. charting software, my market research, all these videos. And yes, there's hours of videos. That's how I teach. You see what I do, then you do the same thing. And the data in the chart package will go back to that time frame, and then you switch gears with me, and early in the morning, at 8:30 in the morning, I record 40 charts. I teach you what's going on, and then approximately now, every couple of weeks, about every 2-3 weeks, I hold a live webinar where you get invited. You can ask questions direct of me. Do people write me during the week and ask me questions? Absolutely. Do I answer them? Yes, I do as well. That's all part of the charting course. So, save 40. All you need to do is go to our website, www.iraepstein.com, under the word education. Remember to enter that code, or you can click up here. If you're watching me on YouTube, it'll take you right there. I'm Ira Epstein. You have a good day.